This segment sponsored by Foster Financial. Welcome to Wealth Wednesday. Today we will receive holistic financial advice from Foster Financial's Vice President, Caleb Doane. Good morning, Caleb.
Good morning.
How are you?
I'm doing well. How are you doing?
Doing good, thank you. Okay, so today we're going to talk about tax accounts, of course, because we're in that season, and you want to kind of hit on required minimums. So tell me about that.
Yeah, so required minimum distributions. We have a whole new group of people turning 73 now that we're in 2024. And of course, that's the age at which you need to start taking required minimum distributions from your pre-tax retirement accounts.
Yes.
So even if you're turning 73, not until December of 2024, you're still required to take that minimum distribution in 2024. They give you kind of a little caveat for the very first year. They say, hey, if you forget to take it, you can actually take it until April 1st of the following year. But then, of course, you'll have another required minimum distribution that you have to take in 2025. So most of the time, we just have our clients take your first RMD in the year that you turn 73 to make sure the IRS doesn't hit you with the penalties that they like to hit you with.
So that is the first year that people have to start taking that minimum. But what you're saying is that they have another opportunity within that year span, but you're like, get it out of the way first.
Yeah, basically, when you turn 73, that's when you start having to take these every single year. The first year, they give you a little bit of a break, and they're like, hey, we'll give you until tax time next year to take it. But then you have to take it every single year for the rest of your life. And the amount that they kind of force you to take out starts increasing too. So, I mean, the first year, it's like a little bit under 4% that they make you take. But I mean, if somebody has 500 grand in an IRA, let's say, 4%, that's $20,000 that you have to take out. And so all of a sudden that gets added to your taxable income. It can push you into a higher tax bracket, all of that stuff. So it's helpful to have a strategy there.
Right, because these are pre-taxed accounts. So this applies to, give us a rundown on all of the accounts that this would apply to. Yeah,
so the most common ones would be an IRA, which is a traditional IRA. Usually people just kind of shorthand say IRA. An IRA or a 401k where people kind of rolled money, or maybe they just left it in their 401k. 403bs are another one that you're required to take those from, as long as you're not still working at the company. If you're still working there and you're 73, which by that time most people have retired, but if you're still working, you don't have to take the required minimum distribution from that 401k. But everything else you would. There's a lot of other accounts that are less common, simple IRAs, SEP IRAs, there's things like that. Probably the most common one that you do not have to take a required minimum distribution from is a Roth IRA. Because that is an account that has already been taxed, and so the government doesn't force you to take it out and pay taxes anymore.
And so I think about different strategies that people can take. My mind's moving because I'm like, okay, you say that there's one which is Roth. So would that be a reason someone should gravitate towards a Roth earlier on to not have to deal with that penalty now? Yeah,
that's a great question. And that's a big thing that will kind of help people with. I mean, even years before their required minimum distribution start, we'll start maybe splitting contributions between a pre-tax account and a Roth account. That way you don't get hit with these big, RMDs when you're older. But even if you haven't done this, let's say you're turning 73 this year, it's the first year you have to take a required minimum distribution, there's still strategies that we can use to kind of limit the taxation of that. Qualified charitable distributions is a big one where you can actually, let's say you normally donate 10 grand to your church every year, your RMD is 10 grand, you can just go directly from your IRA to the church, doesn't show up on your taxes at all. So if you donate your required minimum distribution, you don't have to pay taxes on it, which is a nice little perk. So that's something we'll probably talk about even in the coming weeks here too. Another one is Roth conversions, where after you take your RMD, you can take more money, move it from the pre-tax side over to the Roth side. You have to pay taxes in the year that you do that on the money that you convert, but then once it's converted, there's no RMDs on that money ever again. And so sometimes what we'll do is we'll say, hey, look, over the next couple of years, we're going to do a couple big Roth conversions, pay the taxes right now, and then it'll lower your RMDs for the rest of your life.
Okay, that is good. Okay, I see the strategy there. But then when is the time frame? So you mentioned when they turn 73. So about a month out from that age, a certain time of the year. When is it best to do these?
That's a good question. Honestly, I would usually encourage people to take it early in the year that they're turning 73.
Okay, they don't even have to be 73
No.
yet. Okay.
Yeah, so if you're turning 73 on December 15th of 2024, you can take your RMD right now and just kind of get it out of the way. Sometimes you'll see people will kind of delay it until towards the end of the year, and then all of a sudden these companies are kind of swamped, and it's difficult to get them to send you your required minimum distribution. Wow. And sometimes people have IRAs at many different places, right? They have an annuity here, they have an IRA here, they've got a 401k there, and they might want to take that required minimum distribution from all three of the accounts.
See, that's a good point, because I was wondering, okay, so is that amount that they are required to take annually, is that out of one account, all accounts, each account?
Yeah, so it's kind of both, actually. So they'll aggregate, the government basically aggregates the value of all your pre-tax accounts. Let's say you have 3 of them with $100,000 each. They'll take that certain percentage rate, let's just say it's 4% on 300 grand. They'll say you need to take out $12,000 this year. Now you can take it out of any of those accounts, but you have to take out $12,000 in total. So you could just take it all out of one, but you want to make sure you look at the other ones to make sure, okay, this is what the RMD was, and I've satisfied it by this one big withdrawal.
Okay. Wow. What it sounds like to me are so many moving pieces. So much to think about, which is why a financial advisor is just so important to lay it all out, and you all know the rules and the laws and all of that. Okay, awesome. Well, thank you so much, Caleb.
Yeah, thank you.
And of course, Foster Financial is here to help with tax strategizing, so you can give them a call and you can schedule a complimentary consultation. We'll have their phone number listed below, and we'll be right back. This segment sponsored by Foster Financial.